Hey party people, it's Ben from Pivot Wealth here, and happy December everybody. Super exciting to be into summer and silly season, and looking forward to the Christmas break after what's been a pretty sort of tumultuous year with all the COVID disruption and lockdowns, etc. So guys, today I'm here to run through market updates for November, chat about some of the things that we're seeing, some of the tips, hacks, and things for you to be thinking about to get on the front foot into 2022. So guys, please don't rush out and make any life-changing decisions off the back of what I covered today. I would strongly encourage you to seek out personalized advice from someone with a glorious beard before doing that. Guys, so firstly, markets. Some of the things that I'm seeing, a big collapse in housing affordability. There's been a lot of stuff out there, property market running really hot. Basically all around the country, from the regions up and down the East Coast, and even over to the West. I think a lot of that, and that coupled with the fact that wage growth is not increasing, is causing a bit of a crunch. I think my take on it is that with the ultra low interest rates, obviously that's a big driver. I think that the RBA and the banks are pretty hamstrung though in terms of their ability to increase interest rates too much, because they know that if they do that, they don't want the property prices to decline. The banks are the biggest landowners in Australia. The RBA is very invested in ensuring that households are feeling prosperous, because then they spend more and it helps the economy to bubble along. Inflation has been ticking up though, and I think partly by a bit of a price crunch for a lot of goods. Petrol is going crazy at the moment. I just filled up my car this morning. It's like $150 or something, which is ridiculous. And then also, I think that just the lack of supply for a lot of things has got consumers a lot less price sensitive, as well as with the lockdowns, people got a little bit more disposable cash to make that less of an issue. I'll go into the numbers, but it has sort of come back a little bit, which is good to see. But it's probably above where the RBA would want that to be. And if it does keep pushing up too much, then it might force the hand of, say, the RBA to look at raising interest rates sooner. And obviously this bloody Omicron variant of COVID, total nightmare, when we just think we're sort of getting to the other side, bit of uncertainty around that. Fingers crossed that it turns into nothing and is not a thing, but I think that is causing a few issues, certainly a lot of uncertainty, and also definitely in markets. We're seeing that in the share markets. US has taken a pretty big bath during the week, sort of bouncing back now, but that's sort of a bit of a flutter, I think, which is a potential issue and one to look out for coming into December. In terms of the actual numbers and where the markets are at, the ASX in November, the Australian share market, so the top 200 companies in Australia, was down 1.56% in November. The S&P 500, which is the US 500 largest industrial companies in the US, are down 1.1% for the month. The NASDAQ, that says 10.37, but it's actually down 0.37%, so 0.37% down on the NASDAQ. And the cryptocurrency index is down 3.96 for the month. That's the S&P mega cap index, which is basically Bitcoin and Ethereum, down a bit, but still holding ground, interestingly, from like the massive price rises that we've seen over the last little bit. So for all the crypto investors out there, happy days. Looking in terms of things to keep an eye on in the market, we're seeing a lot of volatility around this COVID, the disruption markets, Omicron, etc. Coming into the Christmas lull though, so you'd expect a bit of a peak in activity and then things will quiet down over the silly season. Generally is what happens. Who knows with this new normal what that looks like, but I would expect it to see a bit of a sort of steady as she goes across the markets for that Christmas period. And the TINA factor is still kicking, and TINA stands for there is no alternative, because I think a lot of investors, certainly a lot of people that I'm talking to, and a lot of younger investors in particular, are thinking like cash rates are ultra low, not really getting any money on the money that we've got sitting in a bank account. The share market is sort of tracking sideways. The property market's super hot. So what do I actually do with this cash? And at least with the share market, that you get some dividends and income yield on your investment. So I think it's pushing more people into investing in shares as opposed to just holding their money in boring old cash, earning 0.5% in a bank account. Our investment story of the month is Fisher and Paykel Healthcare, though, the healthcare part of that brand. These guys do medical and respiratory devices, and they just posted a massive first half profit of 222 million. I suppose it, in a way, no surprises off the back of the COVID requirements for, they do respirators and those sorts of things. So there's been a big uptick in their sales there, and the shares are up accordingly 6.32% for the month. So one to keep an eye on. Who knows what happens on the other side of COVID, although I think you'd see a lot of countries and territories sort of prepping for making sure that they're prepared for, any future sort of events like COVID, which caught people unawares. In terms of the Australian economic data, inflation is running at 3%. I mentioned that that's been a little bit high before, but it's actually down from 3.8% last month. So while it is higher than where the RBA would like it, it is declining, which is what they would want to see. Economic growth for the year at 9.6%, which is pretty crazy, given I suppose the COVID disruption, but it is off a bit of an interesting base when we're looking at, this time last year where the economy was in heavy sort of lockdown. Unemployment is steady at 4.6%. But unemployment growth is still kicking along, 2.4% we've got there, but it's slowing. And the difference between unemployment and employment growth is the growth of the number of jobs that are out there, the number of people in employment. And that's at 2.4%, but it's down from 5.4%. So you can see that that's actually slowing down. Certainly not what I'm seeing in the labour market. For me, I'm seeing frenzy of activity. We're trying to hire at the moment and have been for a little while for some financial advisors. And it's been, really, really tricky because there's a lot, it seems like a lot of jobs, but not a lot of people on the market, probably this great resignation, something. But interesting one. And I suppose it might be segmented to different industries depending on, how those things sit. China economic growth 4.9%, which sounds pretty amazing, but interestingly, it's down from 7.9%, which is a pretty significant reduction in growth. And the Chinese, I suppose, with their approach to economic growth, typically their target, I think, is 7% for regular economic growth. So they're falling short of expectations there, which knowing the Chinese approach to stuff, that would not be on purpose. So an interesting one, I suppose, partly probably because of the ongoing lockdowns, which have continued over there as well. And the last one here is the AUD to USD is we're now buying 74 cents down from 73 cents last month, which is good if you're buying gear from the US. Not so good if you're selling the US tech company stocks and bringing that money back to Australia, but only marginal, I suppose, in terms of the decline there. US economic data we're seeing, and the US economic data is important because it's the biggest economy in the world, or one of the biggest economies in the world, and it does have a big influence on the different markets and economies around the world as well. So what we're seeing is lower spending and lower growth in the US market. There has been a drop in disposable income, which is mainly driven by the unemployment insurance benefits over there that have been winding back. They ramped those right up off the back of all of the COVID disruption, but with their vaccination rates increasing and economy opening up, that they're winding back on that those benefits, which is slowing, which is causing that drop in disposable income. We're seeing an increase in jobs growth, which is a positive thing, certainly for the total economic activity. Unemployment figures have declined, which is a good thing, probably because maybe they're not getting as big a checks from the government for not working, potentially. And one of the big things, actually really important for markets and economies and a whole bunch of things around the world, is that we've seen the increase on the bond yields in the US up to 1.55% over the last month. And that's important because they were at ultra low rates for a long time, and at 1.5%, that investors, like below that level, let me say it a different way, below that level, a lot of bigger investors sort of think, well, what's the point? Because we're getting 1% or potentially even less than that. We'll do something else with our money, and they sit it in the market, hoping that the market bubbles away and they get that with growth. Whereas when the bond yields increase, and it means money comes out of the market, and I think that's been responsible for some of the dips that we've seen in the last little bit. Some of the trends that we're seeing from people that a lot of would-be property buyers waiting on the sidelines. Talking to a lot of people, and I think, like I said at the top end of this, that it has been a pretty average year. So I get that people want to sort of just hang on until the Christmas break and sort of have a bit of downtime and get stuck back in the new year. But one of the things that I've been seeing more and more, which I think is a bit of a flaw in thinking, is that people are saying, "Oh, we'll wait until next year. The property market can't just keep going. It's got to come back at some point. It's gone up too much, blah, blah, blah." You hear this stuff all the time from people that have been saying it for years. We never know exactly what's going to happen. And I suppose it's always possible that there will be a decline. But in my view, when you look back over the long term, if you bought a property today, January, 6 months from now, it's unlikely that you're going to regret that purchase 5 or 10 years from now. So people are sometimes thinking, "Oh, I'm going to wait for this perfect time and I'm going to come in and scoop up a bargain and run away with the spoils," but it almost never works out like that. So that is something I'm seeing, something to look out for. One of the other things that I'm seeing, and it's also related to property, is that property co-investing, so investing with siblings, family members, mates, becoming more popular, probably because we're seeing such a big increase in property prices around the country, and people are investing thinking like it's an easier way, investing with mates thinking that it's an easier way to get into the market. And in some ways that's true, but one thing that a lot of people aren't fully aware of when they go down that path is that when you invest with somebody else, when you go to invest in the future and buy another property, the bank looks at the debt that you and your co-investor have on a property as if it's all your debt. So if you and your brother or sister go and buy a property together, you each borrow $500,000. When you go to buy your next property, the bank looks at you as if you owe for both $500,000 loans, which impacts your borrowing ability, your ability to borrow and buy more. And especially if you're young, I see it play out where then people do it when they're younger, buy with a sibling potentially, and then they get a little bit older, get into a relationship, and then go to buy a home with their partner. But you might be unable to do that in the way that you want because the bank looks at you as you having all of this debt. Then it becomes difficult. Then you have to sell what could be a good property, restructure, gets expensive. There's tax. There's a whole bunch of stuff there. So not to say that it can't work, because certainly there's a lot of good stories out there that show that it can. But if you're going to go down that path, just make sure that you're doing it with open eyes, that you're aware of the implications and what that means long term, and think about it before you jump in. A lot of nervous would-be share investors out there as well. I think we've seen markets up, markets down, a little bit of a dip in the last week. But look, I think, again, if we're thinking long term, if you're making the right move at the right time, then and you can let your money bubble away in the long term. A lot of good value out there in the share market at the moment. Plus, with shares, and Australian shares in particular, they pay you a good dividend yield over time. So if you've got money that's to be invested for several years into the future, I wouldn't be trying to time the market, because it's almost impossible to do. Just find good investments, make it happen, and be consistent. And the other thing, and I've had this conversation a stack of times in the last month, but this interest rate frustration, and I touched on this before as well, where money's sitting in a bank at 0% interest or 0.5% interest or something like that. And people the common scenario is that people want to, say, buy a property in 6 months' time or 12 months' time, and they look at they've got $100,000 in a bank account and it's earning them almost nothing from an interest perspective, and they get frustrated saying, "Oh, this money should be working harder for me." But I just mentioned that investing in the share market, I think, is a great idea, but because when you invest in shares, if the market tanks, it could be flat for like 7 years or more, meaning that you would need to leave your money bubbling away there to get the long-term returns that you want. So you can think of keeping money in cash. When you have money in cash in the bank, then you know that you can just grab it out at any time, go buy the property when the timing is right. So you can think of it when even though you are getting a low return, and it could be your money could be making you more money probably somewhere else, you can think about it like you're paying a price for an insurance policy that allows you to do the things that you want to do with your money over time. And that is certainly very valuable, not only from a peace of mind point of view, but by you getting into the market in 6 months instead of in 6 years if the market's tank and you don't want to sell your shares. there's a lot of value in doing that as well. So the frustration is totally natural, but when you crunch the numbers, think about, what the cost is of you not investing that money for the next 6 months, or probably a few $1,000. Is it worth a few $1,000 for you to be able to buy the property that you want at the time that you want, or do that thing that you want at the time that you want? Probably. So like I say, frustration natural, but just make sure you're aware of those implications before you get too frustrated and force yourself into taking some action that might have consequences you weren't intending to create. Another thing that I'm seeing, cryptocurrency is increasingly on the radar. We're seeing some stuff come out from CBA talking about allowing payments and trading of crypto on their NetBank platform, which I think is great to see from an access perspective. But it's increasingly, I think, that people talk about it being fatty, and then it goes up, and then it goes down, and it goes up, and it goes, but it keeps, every time it goes up, it sort of goes down, but then it goes up to a higher point, and that just keeps happening. And I think people are watching that, especially people that have got an interest in markets and crypto markets. And now it's getting pretty difficult to deny. So it's increasingly on the radar. We're seeing first cryptocurrency-based ETF come out during the month. It's not a pure crypto ETF in that it doesn't own Bitcoin or Ether or other cryptocurrencies, but it invests in companies that are involved in the blockchain and digital asset space, like trading platforms like Coinbase and those sorts of companies. I think it's one to watch. Personally, I've changed my tune a bit on crypto. I don't think it's not an investment that you would want to have all of your money in, but I think it is increasingly having more of a place in a good, well-rounded portfolio. Guys, some of that hacks and mistakes that I've been seeing from people over the last little bit, and some of the stories as well. And this, firstly, I'm going to start with a story of a client that I was working with recently, or that we're working with at Pivot Wealth. It was an individual, income $220,000, had some property that was owned with family members, share portfolio around 50 grand. Frustrations were paying too much tax, lacking clarity on the sort of pathway they were on and where they were headed. And what they wanted was a clear plan and optimizing, getting the most out of the things that they have now. What we ended up doing was tidying up existing investments and just getting them all considered and working together in the same direction, purchasing an investment property, and being smarter with tax around gearing and superannuation as well. The benefits were clarity on direction and cutting tax bills significantly. And the value of that in year one, when we quantified it, was $70,000. By year 20, it was $2 million or thereabout, just a little bit over actually. So, the reason we share these stories is I think a lot of people don't talk about the ins and outs of money, and they wonder what is possible, especially if you haven't gone down the path of putting together a robust plan before. You don't know what to expect or what the ROI might be. This is only obviously the numbers, not just not on top of like the confidence and peace of mind benefits, but I'll continue to share these stories so that you can learn from some of the things that other people are doing in this space and know what you should expect when you do ultimately go down that path. Money mistake of the month is letting fear hold back your investment decision making. This is a really big one, that people, you want to do something, you should invest, you got to make your money work harder for you, but not sure where the risks are, what the risks are, where they're coming from, how you can manage them. And then you get this fear of making a mistake. And from that point, you can either blindly jump in and hope for the best, or you end up paralyzed with fear and you end up doing nothing. And then a month goes on, and 6 months, a year goes on, and then all of a sudden it's next New Year's and you still haven't taken that action. So the key to breaking through that is educating yourself, focused knowledge, so that you know what you need to be doing to get the results that you want. Money hack of the month is building on your New Year motivation. I thought it was fitting this time of year. We see a lot of people pumped up to do some stuff with their money, get on the front foot for the new year. But unfortunately, we see those same people the year after, and sometimes the years after that in January, and they still haven't taken the action, and the New Year's keep rolling around. So I would say, if that's you, if you feel like there's some stuff that's on your list that you need to get squared away, use your New Year's motivation, make it happen, put some structures in place, put a process in place, put some time aside, and make it come together for you, and ultimately take action so you get results. Client problem of the week. This came up for a client recently, just converting USD to AUD. They work for a tech company with bringing a bunch of money back from the US. went to put it through their bank. It was like a $30,000 difference between the interest rate that their bank offered them and what was possible with the Forex provider. And when they went back to their bank offered to match the rate. Just by asking that one question, saved themselves $30,000. So a bit of an issue if you're not aware of that, and you are bringing cash over across borders. Just to have a chat to your bank. Look at one of those Forex providers that are online. They generally give you free quotes, and then you can shop that price around. Make sure you're getting the best deal and getting the most out of your money. The success story of the month came from a client that I was talking to recently. Just reminded me that we invested a bunch of money in the depths of the COVID sort of market meltdown, and they've made a ton of money. It's like massive upside from a dollars perspective off the back of it. And I can remember back to I actually caught up with them yesterday, and I can remember back to the conversations we were having, and they were quite terrified at the time of pulling the trigger. We assured them, all the risk managed plans set, etc., looking at our long-term averages and dotting the I's. And they sort of had the strength and courage and knowledge and confidence to push through, and they've done that and got the results. So I think sort of goes back to what I was saying about property market. People are talking about fear, uncertainty. That's the time that you want to be investing, not the time that you want to be waiting to see what happens, because by the time you figure out what's happened, everybody else has as well, and then it's too late. My book of the week or book of the month is Rich Dad, Poor Dad. For anyone that hasn't read it, it was a formative book for me. It goes through some really simple, practical tips that you can use to get better results from your money and more out of what you have. If you haven't checked that out already, it's basically everywhere. So do that. And that's it, guys. I hope you found that helpful. Look, if there's anyone that you think would find this helpful, please feel free to share it along with them. It's on all of our social channels and the Pivot Wealth website, pivotwealth.com.au. Guys, have a great December. I'll catch you in the new year.